So make sure you're writing this down. Identify the market direction on higher time frames, so weekly, daily, and 4-hour. Identify the trend. So is it bulls or bears? Is it highs or lows? Market movement, momentum, impulse, and in pullback and corrections. Buy before momentum moves happen and sell before momentum moves happen. You never want to be caught in a buy or sell on a pullback move / consolidation mode. Always use multiple confirmations. So you don't just want to use resistance and support. You want to have extra confluence. So a chart pattern, candlestick analysis, Fibonacci, which is what we're going to go over. Just multiple confirmations, not just relying on one. So following the market trend, remember we're either in an uptrend or a downtrend. Uptrend is long and bullish, downtrend is short and bearish. Trading with the trend is super important. A trend occurs when a currency pair moves in an upward, sideways, or downwards direction over a specific period of time. Our goal as a retail trader is to think like the market makers. So we already went over this. Identifying the trend. So what is your trading style? Depending on what your trading style is, swing trader or intraday, that will help you identify which time frame you need to look at in order to identify the trend. So swing trader is mainly 4-hour, daily, weekly, and monthly. Intraday, 1 hour, 4 hour, and daily. So you'll figure what kind of trading style is yours when you keep practicing and figuring out what works best for you. So please use 4-hour daily to identify the trend. What is the trend? So is it an uptrend, downtrend, or consolidation market? So the bigger the time frame, you'll be able to realize, okay, this is a clear downtrend. This is a clear uptrend. Highs and lows, identifying movements in the market. So uptrend equals higher highs and higher lows. So this is exactly what happens. So buyers come in the market, make a higher high, come back down, respect. This is a pullback and correction, and we call this a higher low. So then higher high. So this high is higher than this previous high, and this higher low, because this is a low, is higher than this previous higher low. So I'll explain this in the course. So then obviously this is consolidation and it's ranging. And then this is a downtrend. So same thing except lower highs and lower lows. So just make sure you write that down. So bullish equals rising, bearish equals declining. So we have our higher high, higher low, higher high, higher low, higher high, higher low. And then this is where a trend line comes in place as well. It's an extra confluence. So bearish, lower low, lower high, lower low, lower high, so on and so on. So we went over that. So understanding market swing movements. As we've learned so far, the market moves in waves, which are known as swing points. The market is never going straight up or down. It goes from low to high to low. By identifying these swing movements, we can figure out where to enter and exit the market. So uptrend, like I said, high and low points, which we can also name them tops and bottoms. Okay, so higher highs and higher lows. Higher highs equals each top swing point is higher than the previous one. I just went over that. And then higher lows, each bottom swing point is higher than the previous one. Once a higher high is formed, price then begins to retrace and consolidate, which is a pullback. When higher lows are formed after the consolidation and retrace, the market gets more buying pressure to continue the upwards trend. So same thing happens in a downtrend, except it's bearish and we still have tops and bottoms, but they're lower highs and lower lows. So lower highs, each top lower high point is the highest level than the previous. Lower lows, each bottom is the lowest than the previous. Once a lower low is formed, price then begins to retrace and consolidate. When lower highs are formed after consolidation and retrace, the market gets more selling pressure to continue the downwards trend. So identifying tops and bottoms. Okay, so this is when we're starting. So this is a lower low, and now we're starting our uptrend. So higher high, higher low. So this is the tops, and these are the bottoms. So if that's easier for you to identify them, then so be it. But just make sure you know the difference between higher high, higher low, higher high, higher low. Okay, so here's another example, Euro USD 4 hour. Higher low, higher high, higher low, higher high, higher low, higher high. Okay, so these are the tops and these are the bottoms. And we're in a clear uptrend. So identifying lower highs and lower lows. So we got our tops and we got our bottoms. So our tops are named lower highs and our bottoms are named lower lows. Same thing here, lower high, lower low, lower high, lower low. And then this is just basically a lower low. I just named the whole thing lower high. I just named the whole thing instead of just going here and here and going lower high, lower high. So you can do this if they're at the same level. Lower low, lower high, lower low, lower high. So consolidation, retrace. So this is what I mean. Price comes down, consolidates, continues down. Then consolidates, pulls back, continues down. Consolidates, pulls back, continues down. So it needs to have a consolidation and retrace. So uptrend to downtrend. So higher high, higher low. And then we have our higher high, and then we have the same high, and then eventually price starts going into a downtrend. So this is when we can identify chart patterns. So if you guys remember, this kind of looks like a double top, doesn't it? So that's another indication. So we have two confluences right there. So this is on Euro USD 4 hour. So like I said, higher than the previous higher high. Okay, they have to be higher in order for it to be a trending uptrend. Follow the trend. So following the trend is extremely important when learning how to identify or how to trade. I always identify your lower lows, lower highs, higher lows before entering a trade. When a trend breaks, you will usually see a period of consolidation, which is what we just went over, and we want to stay away from entering the market when price is in consolidation mode. So reversal highs and lows. So identify the trend, bullish or bearish, aka uptrend or downtrend. Uptrend is higher highs and higher lows. Downtrend, lower highs, lower lows. Did you identify a lower low in an uptrend? Great. Reversal is ready and it's time to find your entry. Did you identify a higher high in a downtrend? Great. Reversal is ready and it's time to find your entry. When we are in an uptrend and we keep seeing higher lows, at some point the market will start to fall and the distance between those higher lows gets smaller and we finally can identify a lower low. So the low of the last higher low will break when the candle closes below that level, which in return gives us a great setup to enter a short. So this is what I mean. So as you can see, price comes down, consolidates for a bit, then comes back up. Price continues to make higher highs. Then price comes back down, tests the support. So we have multiple confluences. We have our support and resistance. We have trend lines. We have chart patterns, okay? We have our higher highs, higher lows. Like we have multiple confluences, and this is what you need. Then we see a double top pattern, and then we start to see lower highs and lower lows form. So for your trend lines, you go to this toolbar right here on TradingView. That's how you find your trend line. For the rectangle, you just go to here and you press rectangle and you can change the colors, and then the text is there as well. So once you're practicing on TradingView, you'll see all of this. Pure price action market structure. So here's an example on the 4 hour on GBP AUD. Price comes down, consolidates, pulls back, shoots down, consolidates, pulls back, shoots down, consolidates, pulls back, so on and so on. Okay, so that's why it's so important that we understand our lower highs and lower lows. Then eventually we get a huge range consolidation, price respects support, and eventually actually goes up. So then we get our higher highs and higher lows, and we're in an uptrend. So when we are in a sell, we always want to get in a sell on those corrective moves, and we can hold our sell positions until price tells us otherwise and continues in the opposite direction we want to get out. So we're selling in a downtrend and we're buying in an uptrend. Break of an uptrend. So we have our higher lows, then eventually we get a break, and we want to put our stop loss above just in case price does come back up. So once price breaks, price retests, and we can clearly tell that price is dropping and is no longer in an uptrend. And this was a 900 pip move actually, which was crazy. So a break of a downtrend, lower lows, lower highs, price consolidates for a bit, then we get a break, and we can see that price is no longer in a downwards movement, and buyers come in, and now we're in an uptrend. Break of an uptrend on the H4 time frame. So we have our higher lows, come back up, we have a nice bearish candle, price starts to fall, break, multiple rejections of this area, and then we actually finally get a break of support, which this was a 150 pip drop. So momentum and correction. So we have our impulse down, our selling momentum, then we have a correction. Then we have our impulse down, which is our selling momentum. Then we have a correction and a pullback. Okay, so price exhausts and keeps going down. So we call this impulse and correction. So a correction in an uptrend, we have buyers in the market, comes back down for a pullback and correction, comes back up, consolidates, goes down for a pullback and correction, continues up. Downtrend, so price comes down, comes back up, consolidates, correction, pullback, price comes down, same thing, so on and so on. So once you are able to identify this, it becomes really, really simple to just see every single time. So practice makes perfect, trust me, and it just takes time. So psychology of institutions. So understanding how the big players in the market operate is super important, because at the end of the day, big money equals market movement. We are not the ones that are moving the market, okay? We are a very, very small percentage. So that is why understanding market trends, key levels of support and resistance, breakouts and retests, and more are crucial to your trading success. So stop loss hunts. So many traders set a stop loss order at a specific level to limit their losses. So a stop hunt is triggered by the big players in the market, and sometimes it will hit your stop loss and continue in your direction. So if you're in a community chat with the traders and they'll say, oh no, my stop loss was hit, whatever, that's basically usually what it is the market will hit your stop loss. So many people don't get that they actually don't care about your specific stop. They only care if there are a large number of stops on that specific price level. So example, if you place your stop at a key level in the market and there are a number of retail traders or banks that also have that stop loss at that level, you're more than likely to be stopped out. The more transactions there are, the greater liquidity. So why does the market hit your stop loss and continue the desired direction? So price is actually attracted to the supply of the liquidity at those major key levels. So the supply gets taken out and then it will reverse. So that's how it works. So how to avoid stop hunts. Do not have your stop loss too close above or below that key level. This is what will cause you to be stopped out. Set your stop loss further away from the key level and set it to where it invalidates your trading setup. Okay, so that's the biggest thing, and we'll go over that. But you want to give the trade room to breathe. That's the biggest thing. So if you're setting a tight stop, it's going to get stopped out more than 90% of the time. So you want to widen your stop and you want to give it room to breathe. So here's an example of stop hunts. So this could be a news event, but basically price came back up, then wicked at this level and came back down. So these are all important levels. So let's say you had your stop at these certain levels, you would get stopped out if it was too tight. So that's why I'm saying, like, let your trade breathe. Okay, and then the market actually tricks you too. So it's thinking that, oh, okay, it's going to break this level right here. Nope, it wicks and comes back down. What does it do it again? Wick, comes back down, so on and so on. So you have to be, that's why break and retest are so important. So here's another example on GBP USD 4 hours. So if price is reaching a support or resistance level, wait till it actually moves above it and triggers the stop loss orders and wait for price rejection. As you can see, you do not want to put your stop loss 5 to 10 pips above. As you can see, price took out stop losses and continued down. Set your stop loss where you know you are in the wrong. So what is Fibonacci? So Fibonacci is an extra indicator that we use. This is literally the only one I personally use, but I find it very effective for entries. So Fibonacci was actually invented by an Italian man. Italians were some of the Western world's most skilled traders and merchants during the Middle Ages, and they needed arithmetic to keep track of their commercial transactions. So in the FX market, we use Fibonacci retracements as a tool for identifying retracement levels in the market to potentially enter trades. So this is how you find your Fibonacci tool. You go to the toolbar on TradingView, click this, click Fib retracement, and make sure you mark that as a star so you'll have it all the time. And these are the numbers that you want for your fibs. So make sure you write this down, just the ones that are checked. And then make sure you have prices and levels checked. And you can make them whatever color you want. Have all of this information on there, just the check stuff, and yeah. So Fibonacci numbers. So this is what it will look like. They come out as percents. So we have negative 61.8, negative 27, 0, 23%, 38.2, 50, 61.8, 78.6, 100, and then we have 127 and 161. So market wave. So momentum move is A to B. B is exhaustion and pullback, which is what we talked about, kind of like our higher highs and higher lows. And C is new buyers enter the market and the momentum continues. So using fibs, we need to identify the swing high and swing low points. Price always pulls back to a certain percentage before continuing up. So this is what it kind of looks like in a bullish trending market. So in an uptrend, place your Fibonacci tool from the lowest bottom, which is right here, to the highest top. So swing low, which is 100. So 100% is right here for your lowest bottom, and then the 0% is at the top. So taking profit around the 0, the 0.27, and the 0.618 is the most common. So make sure you're drawing this. So Fibonacci in a bearish trending market. In a downtrend, place your Fibonacci tool from the left to the right. So the highest top, so the 100 goes at the top and the 0 goes at the bottom. So just remember, in a downtrend, 100 goes at the top. That's all you have to remember. So in an uptrend, so we have our swing low. So we put our 100% at the bottom to our swing high. So this is the highest point. So that would be 0. So entering the market in an uptrend. So price comes up, tests this 0%, then comes back down. So the Fibonacci levels actually represent support, okay? So you can use them as support. So after it hits the 0%, it's either going to retrace from 38.2, 50, or 61.8. 61.8 and 38.2 are the most common, okay? Especially the 61.8. So you just want to see how price reacts at each level. And then for your 78.6, you want to have your stop loss, because that basically indicates that price is actually going to continue to fall down, not go back up. So you just want to have it kind of below 0.786. So 50% fib. So 50% fib is important too, because from the price from 100% to 0%, in the middle is 50%. So price can reverse from here as well. So anywhere from 38.2, 50, and 61.8. Usually 61.8 and 50, and then when it hits 38.2, it's a really, really strong movement, like I illustrated here. So again, this is an extra confluence. Okay, so downtrend, we have our 100 at the top, we have our 0% at the bottom. We can see that price came up, tested the 61.8, wicked. This is our resistance, and price began to fall down. So usually it will fall down to the 0%, but sometimes it can retrace to 0.27 or the 0.618. So these are good exit points. Again, guys, this is the basics. I will go over this in other videos. So Fibonacci extensions. So these are when it goes past the 0% or the 100 in a downtrend. So swing high to swing low. So 0%, 100% at the top. We can see that price went to 0, then came up, tested the 61.8, and then continued up and actually passed the 0% and came to the 1.27%. So this would be our first take profit. So fibs are really good for entries and exits. Amazing. And I will teach you all of that. So Fibonacci extensions on USD CAD 4 hour. So we have our A, we have our B, and we have our C. Okay, so this is how you can mark it up so it's easy for you. So 100% at the top because we're in a bearish trend, 0% on the bottom. So A, B, C. So what happens? It goes to the 38.2, wicks, and continues down. And then eventually passes 0% and goes to 0.27%. Here's another example on AUD USD 4 hour, 100 at the top, 0 at the bottom, A, B, C. Price goes in the middle. This is exactly why you don't want to have a stop loss right above the 61.8, for example, because a lot of people do, and you'll get stopped out, and then the trend will continue to go down. So you want to have it near the 78.6. GBP USD 4 hours. So this is an uptrend. So we have the 100% at the bottom. Then we have the high for the 0 right there. So we have our A, B, C pattern. So this actually came back and tested the 61.8 and flew up. USD JPY 4 hour, same thing. 100 at the bottom, 0 at the top, A, B, C. So it's usually around the 61 and 50% level. So buying in an uptrend, so this is kind of what it looks like on the hourly. So we have our 100 at the bottom, and we have the 0% at the top. So price retraced the 61.8, which is our buy signal. Our stop loss would be around this area, and look how price flew up and is kind of respecting the negative at 27%. So this is where we would take profit. So choose two currency pair charts and identify the swing points in an uptrend and downtrend. So your higher highs and higher lows, lower highs and lower lows. Choose one currency pair and identify a consolidation. So show me what consolidation is. Choose one currency pair chart and identify a bullish to bearish trend. Choose one currency pair chart and identify a bearish to bullish trend. Choose two currency pair charts and mark up impulse and correction movements. So momentum, pullback, momentum, pullback. Choose two currency pair charts and identify stop hunts. So show me what the stop hunts are. Choose three currency pair charts and identify bullish Fibonacci and bearish Fibonacci. So then after you're done that, please submit. And guys, go over these videos as much as you want, and just so it helps you and so you understand. And then I will explain all of the stuff in advanced videos as well. But just make sure you're understanding the basics.